Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is May 24th. We have oil, Brent crude, continuing its positive run from recent weeks in Asia this morning, trading up 1% at well above $77 on Brent, 77.58 at the moment. So all signals are pointing that there is some momentum in this market. Let's welcome back to the table after a spell away Sarah Akbar, chairperson and CEO of Oilserve Kuwait and non-executive director at Petrofac. Sarah, your thoughts on the oil market momentum we've seen this month after nearly once again touching $70 on Brent. We've got that spring back upwards. What do you think is giving wind to the sails of the oil price at the moment?
Well, I think it is demand. After all, demand this year is really up. And there is a strong demand underlying all this. So I guess the balancing act that OPEC plays all the time keeps things in balance. And this is their objective all the time, to keep the balance between supply demand and stabilize the market. And I think whatever they are doing in OPEC to see forward, like 3-4 months forward, actually works. And that's why the price is where we see. Although, inflation in the US and generally is kind of stabilized. So the economic fear from the inflation is kind of muted now. But of course, the fundamentals show economic weakness, which is probably the reasoning why we have it at this price, around $75. I think if we had some encouragement on the fundamentals from the economic growth globally, then I think the price would have been in the range where OPEC initially thought it would be, between 80 and 90. But at this point in time, I think one of the main reasons is, this control over inflation that actually is kind of working in the US and elsewhere. And this is why you see this pricing at these levels.
Let's welcome Rachel Ziemba, founder of Ziemba Insights and an adjunct fellow at the Center for a New American Security. Rachel, we had the Saudi energy minister, Prince Abdulaziz bin Salman, talking yesterday again, sort of giving that sort of warning to short sellers and sort of, if you like, talking up the market a bit, on top of a month ago actually announcing unilateral cuts, voluntary cuts that have come into effect this month. Your thoughts on that, sustaining that momentum in the oil price rise that OPEC Plus have clearly choreographed, and the minister yesterday adding some fuel to that?
Sure. So I think yesterday's comments that, of course, were sort of on a day of a number of Gulf oil minister comments, the Qatar Economic Forum and elsewhere, I think were designed to kind of continue to sort of point people back to some of the fundamentals that Sarah just mentioned, right? I think we've seen the oil ministers be very concerned about the sort of position of shorts in the market. If we look back a week or so ago, if anything, the short positions were still very extensive, almost as much as they were a month or so ago. That, I think, has a lot to do with this sort of rolling phase in of some of the financial stress out of the United States in particular, right? I mean, it's one of the reasons I think that oil markets have stabilized in the last week or so has also been about a reduction in some of that perception of financial stress, of bank runs and the like. And that link there. We've also seen global equity markets rise to some extent. So I do think that this sort of focus is back towards fundamentals. What can they do going forward? I think really clarify and commit to some of the cuts they've already announced, right? Now we will see what comes up at the next OPEC plus meetings. They might well commit to asking all countries to do what they've already agreed to do. Russia, I think, remains one of the big elephants in the room here. We might come back to that, but ultimately, this is a story of, demand's picking up. It's not picking up a lot yet. I'm skeptical of how strong Chinese demand will be in the second half. But ultimately, I think this is a story where the reduction in this sort of maybe perception of financial stress from the banking sector has helped. And of course, look, we're looking ahead over the next week to questions about the debt ceiling and other brinkmanship. And so there may be non-oil related financial stress that might continue to sort of be a real sort of problem for market actors.
Let's welcome Salah Yilmaz, Senior Equity Research Analyst for Energy, Oil and Gas Transition, ESG for Bloomberg Intelligence. Salah, in some ways, a lot of this uncertainty on the margins have been sort of knocked off one by one. The inflation, as Rachel points out, has more or less peaked and now declining. The Fed and its associated central bankers have kind of maybe plateaued, but the sort of massive push China's reopened, not quite there yet, but clearly picking up with steam. So a lot of the kind of noise around the edges are slowly backing away and allowing the kind of supply demand fundamentals to play. Your thoughts?
Good morning, Sean. Yeah, I mean, I think this is what we've been kind of arguing since the beginning of the year, that we will have the first half of the year versus the second half of the year type of story. And in the first half of the year, we knew there were quite a few downside risks for oil prices, which have played out. And as you alluded to, in your survey question as well, I think a lot of those and that banking kind of pressure that we saw seem to have been priced in. And I think now when we look at the second half of the year is when perhaps we will have an acceleration in the reopening and the oil demand impact from China and the rest of Asia. And also, I mean, the rest of the fundamentals on the supply side, the extra cuts, the additional cuts by OPEC Plus will start to unfold more starting this month and into the second half of the year. So I think the market, in my eyes, seem to have been a lot more ready to price in the downsides. Understandably, I think, given multiple drivers and overhangs in the market. But when we look at the second half, we are sticking to our original thesis that we are looking at a story where supply is pretty much constrained, with OPEC Plus bringing cuts and staying pretty strong with their view of, expectations are for a slowdown in the second half, so we will be preemptive. And we continue to see them kind of sticking to that. And by the way, very quickly on the next OPEC meeting, as you said, what the remarks by the Saudi Energy Minister Abdulaziz bin Salman yesterday, I think what that also signals is potentially more cuts at the next meeting. I mean, the same kind of reasoning that they used in the last couple of meetings when they did announce new cuts could still work, right? I mean, they're saying slowdown is expected in the second half of the year. We want to be preemptive. If we're wrong, we can always undo that. But then I think there will be a lot of confidence that they have from getting this right the last couple of times. Because I think back in October last year, their decision was a controversial one, but then they turned out to be right, and they're not very shy about making that clear. And I think this last one as well, I mean, arguably, like a lot of analysts argued that, this was perhaps unnecessary. This will really result in a spike in prices, but it didn't, right? I mean, we're still at around 75.
Resulted in a fall in prices.
Exactly. So
perhaps, Sarah, on that point, you have expressed some caution around the commitment of announced cuts. I mean, the announcement last month by what they called voluntary cuts. 9 countries unilaterally decided we're going to reduce our supply. That voluntary nature is maybe I will, maybe I won't. I'm not accountable to anybody. Your thoughts on the clear, most secondary sources are saying that the Russians are definitely not doing it. Whatever about the Gulf states. Your thoughts on the impact of that announcement, its credibility going forward? You're on mute, Sarah. Sorry.
So on the cuts, I think, there is commitment. But, with the commitment comes as well incidents that make those cuts more doable. For example, Iraq now, they've lost 400,000 barrels because they can't ship through the pipeline. So whatever commitments they made to cut, it automatically came in play when this thing happened. But for the rest, for example, Kuwait, Saudi, the UAE, I think they do commit to the cuts, and they actually do them. So, and that impacts the market more than anything else. The small players, even if they commit, they are not significant. The only significant ones are the ones who make large cuts, and they are visible in the markets, and those do commit. Now, about Russia, with the sanctions on Russia, the reality is no one has exact detailed information about what happens with the exports, how things are happening in Russia, about the production. So I don't think they are committed to the cuts, but are they actually cutting it? Nobody has an idea. So they might be in or out, but going back to something that you said in the beginning about, the ministers all talking the same talk, that, the oil prices, we should look at the longer term. Sean, this is real. I mean, they are not making it up. If you don't invest in the business now, in 3-4 years' time, you will be facing a real problem of shortage of supply. So, and the more people push towards other businesses, other things that can, take the investment from the oil and gas, the more we will face this issue. So it is a real thing. It's not just they are hyping it now, because
they're clearly, at least the Gulf states are clearly investing in significant new supply, and you would expect that they will want to deploy that.
Of course, but even with that, looking at the demand, everyone has to invest, not only the Gulf states. Everyone has to invest in finding new oil and in developing new oil. And that is actually not happening. Exploration expenditure has been the lowest for a long time. We are not finding new reserves, in the world. So,
but what are you meant to do with international oil majors who want to give their shareholders billions and billions of dividends and not put it in the ground? You can't force them to do it. Prices are certainly high enough from a historical perspective that you would think very attractive to invest in new supply, and yet clearly that isn't sufficient. I mean, what gets, Sarah, your view, gets these majors back into the game, that the business they've been in for decades?
Well, Sean, what's happening is this huge propaganda machine that's coming from the environmentalists, from EIA, from that, creating that system where, oil is bad, we shouldn't be investing in it, and all the shareholders are backing those views. But, you are shooting yourself in the foot, basically, by doing so. So
I don't think people in Houston are too disappointed at the moment with the profits that the environmentalists are causing them to earn in that argument. It doesn't seem to me that they're too upset. Rachel, your thoughts on the more immediate, because clearly, as Sarah points out, the midterm looks very tight. The second half of this year looks very tight. I was just at a pretty significant a conference here in Dubai the last few days, where the general view was that the second half of the year, we're going to be at plus 2 million barrels above demand where we are right now, 2 million. And OPEC Plus is cutting. I'm wondering your thoughts on that.
Sure. Definitely second half, and as Sally sort of mentioned, second half is sort of likely to be tighter. I On the demand side, I still worry that a lot of people's demand estimations count on a big rebound out of China, and we are seeing some increases there. But I guess I come at a little bit more of a conservative element. But I think this does really come back to this issue of the supply moves that the core OPEC members have made have been tightening the market, and that's going to continue to play out. And that's where I'm really watching. Not only will there be sort of more extensive cuts, but what happens in that regard. On the demand side, though, as I said, I'm a bit more sort of skeptical that it will actually pick up that much. A lot of the indicators we're seeing out of China, yes, they're stronger sort of retail sales and consumption at restaurants and the like. International travel, domestic travel is picking up a bit. I'm just worried that this big sort of rebound in demand might be more a next year, sort of a next year story. I mean, look, we'll see what happens. I was at a conference here in Paris over the last few days where a lot of sort of Fed and other speakers were speaking, and some of the dynamic, I'm not sure they're fully done. They're very close to done, but I think if anything, slightly stronger macro news means we might see some slight upward adjustments to sort of the rates. So I just worry that this ends up being a story where some of this pickup gets pushed a little bit further into the future, because the stimulus people are expecting from China, I think, will be kind of softer than is anticipated. So that does bring us back to the supply side, if anything. And look, that's where, this big question mark in my mind continues to be on Russia. I see that this big, if anything, I think there's a lot more switching back and forth between, on the margins, product and crude oil as the sort of effects of the sanctions come into play. And my supply demand balances do assume a little bit of a cut there. And so I think, if anything, the tighter market is a bit more a story of the supply response than necessarily a big demand side. But, I think we're all watching the data, and, we'll be sort of coming back on here, trying to sort of alert your sort of audience, our community, as soon as possible as we see things change.
Salah, do you think it would be sufficient? I mean, this jawboning by OPEC Plus, the announcement last month, the voluntary cuts, and now they're meeting in 2 weeks' time. If they formalize these cuts, 1.6 million barrels that were announced last month, they are being implemented supposedly this month. But if they formalize that as part of the OPEC Plus agreement, rather than this voluntary as it's currently defined, do you think that would be sufficient to give an $80 plus market?
I think so. I mean, as Sarah said earlier, the important portion of all these cuts are being done by some of the bigger producers, which we know we can kind of rely on. When they say, even if it's a voluntary cut, we know they will deliver them. And especially the Gulf producers. I mean, Saudi Arabia, for example, promising the biggest chunk of those cuts. We know they would deliver even if they kept it as voluntary cuts. But I think you're right. I mean, I think this is one thing to watch at the next meeting. I think it's very much possible that they try to, even if they don't bring extra cuts, perhaps they try to formalize what's already there, and kind of with the language, just talking about how, like this should be enough to keep the market well balanced. But what they'll probably mean is keep the markets quite tight to make sure that prices are above this price floor that we think that they are trying to protect. I mean, we don't know what that number is, but I think $80 a barrel would be a pretty good guess. And we are currently below that. So I think no matter what the decision is, I think that the message that we get from that next meeting is very much going to be about how, like demand is picking up. And it was interesting. And I think Rachel makes some very good points, and it's been rather disappointing at the pace at which China has come back since the beginning of the year. But then at the Qatar Economic Forum yesterday, we had the Qatar Airways CEO talking about how, I mean, their China flights are completely packed, and they are trying to increase capacity, and there seems to be incredible demand for all that extra capacity as well. So, I mean, I know jet fuel part is not the whole story. Of course, some of the data that we follow out of China has been underwhelming, to say the least. But I think, you know, the pace may be disappointing, but the direction is there. And I think there is significant demand to come out of Asia and the rest of China and the rest of Asia in the rest of this year and early next year. And again, I mean, this has been a little bit of a tale of two regions as well. Like, we know the whole macro kind of overhang has been more of a US, Europe, West type of kind of concern, with demand potentially slowing down there. But then Asia, I think many agree, may not increase as much as we thought at the beginning of the year, but it will. Well, add in some ways,
it's sort of everybody in that regard. You know, the adjusting for this expected recession that never seems to arrive, and if everybody adjusts their posture, then inevitably it sort of comes a reality. Let's get the survey question, which sort of picks up on this point. What impact would it have on oil prices if OPEC Plus formalized the so-called voluntary production cuts of 1.66 million barrels a day, implemented this month by 9 member countries when the group next meets officially on June 4th? If they were simply to formalize, not make deeper cuts, but formalize. That was the story, the rumor going around the coffee machine at the MPGC conference in Dubai the last few days, just formalizing these cuts. So your thoughts on that? Push prices above 80, no change, as already priced in the market. Prices will fall without more cuts. So if they formalized, what would be happening? Sarah, of course, what's happening all the time in this region, and particularly most profoundly in Kuwait this year, over the last number of months and going forward, is a significant increase in the amount of refining capacity in the Gulf states, with the Al Zour refinery in Kuwait now pretty much up at full capacity, as we understand it, 650,000 barrels of refining capability there. That's a significant amount of crude oil that isn't going to international markets. How do those two things go together, or does it all wash out in the end from a supply-demand point of view if the Gulf states reduce their crude exports?
Well, you know, these are products that are sold into the market, and they are already in the pack. So there is no additional crude that we are producing and processing in order to go to the market. We are in Kuwait, we stick to our OPEC quota and the reductions, and part of that crude already goes into this refinery. So there is no additional production as such. It's only that we have more diesel available, there is more naphtha available, there is more products available to the market, which is really needed. You know, there is shortage of diesel these days, and this addition will actually help in stabilizing that market. But genuinely in Kuwait, I think maybe we are one of the countries where we commit 100% to the kind of production announcements that we make, and but it's all priced in, because I mean, initially part of the 600,000 used to go to the market, but now it is refined internally and sold as product. And some of this production, some of these products are utilized in the local market, not much, but the majority of it is for export. So.
And meanwhile, Sarah, Kuwait continues its expansion capacity program that's not interrupted by the adjustment of quotas over the short term, but the capacity growth continues unabated.
Well, you see, Sean, the only issue in Kuwait is this political stalemate that we are in, which affects every single kind of decision you can imagine, to the point, you know, KOC, the main company that produces oil, have half of the management it needs in order to operate. So there are 3-4 very senior positions in the company that are not filled for the last almost 9 months. So, and that affects how the company operates. The other thing is that, you know, because of these tensions between parliament and government. As a result of the tensions last year, the government took, I think, like $21 billion from KPC. They took their war chest. So yes, they do have expansion plans. They announced some expansion plans, I think 2-3 weeks ago, but it's not put yet into action simply because of the political stalemate that we have. Now we have elections on the 6th of June, and after that election, we will have a functioning parliament, functioning government, and hopefully that we could go forward implementing the plans. The plans are already there. We know what needs to be done. It's actually just implementing those plans and just moving ahead.
Rachel, you mentioned earlier in passing the infamous U.S. debt ceiling debacle, which is essentially a face-off between the Republicans and the Democrats in a game of chicken. Who's going to blink first as we drive the car closer and closer to the cliff? Your thoughts on where that is at the moment? The indication from a market's point of view would be nobody, the markets have kind of moved on, that this isn't going to end up driving off the cliff. But your thoughts on where we're at with that, and how risky is this situation?
So I think it's very risky. You're right that markets have not been paying much attention to it. I think in part because there's such a range of outcomes, right? And then this question mark of exactly what it looks like. I do think we're running out of time. I mean, there is some time, there is some time between now and about June 1, but not a lot for the back and forth. And so maybe markets are expecting it. But I got into a conversation with a very good journalist yesterday who said markets are ignoring it, journalists are focusing on it, and I said, well, the big problem is that the politicians also almost need the markets to be reacting to act. So I think as we get closer to the point where the Treasury might really have to make choices about what to do with the money, I think which also happens to be very near where OPEC Plus might be sort of trying to make its decisions, we could sort of see some more volatility. I think, look, I'm not in the conversation rooms. It's hard to tell if we're not, but I think the two sides are still pretty far apart. And some of the things the Republicans are asking for to pass a debt ceiling actually undermine investment in their own states. So, we'll see what happens. There's a few days between now and then. But I think it would be wrong to just sort of, continue to hit snooze button on this issue. As we get closer, we might see some more extensive market moves. And that could paradoxically actually mean bigger move into sort of the US dollar and to sort of cash as people look for liquidity, pull out of sort of some of the bonds, and might not necessarily be a pulling out of cash from global, sort of from US markets. But oil, given its financial sensitivities and the like, would likely sort of get a bit caught up in there. It might be short-lived, but it depends how long any kind of default and failure to address this lasts. And the longer it lasts, the more things would be repriced.
Salah, your closing thoughts on that, but and also welcome if you pick up the comments that we were talking earlier about where the major oil majors are. Obviously, you're an equity analyst. You're covering all the big companies, their appetite to expand capacity. Survey result basically sort of 50-50 between no change and push prices above 80, as in I have no idea what's going to happen. Salah, your thoughts and closing comments.
Sure. I mean, I don't really have too much to add on the US debt ceiling side. I mean, we know it's been pressuring prices, so it's certainly relevant, as Rachel said, the kind of the sensitivity to the financial side of things of oil prices. It's definitely moved the needle, and the uncertainty is certainly giving a little bit extra volatility. But very briefly on the oil majors, I think you asked a very interesting question earlier, like how do we get them to spend more? And I think what we always said about higher prices will get them to spend more, and perhaps $80 a barrel. When if we were asked this question 5 years ago, 10 years ago, I mean that would have been a high enough price point. But perhaps now, with everything that's been going on, with that extra shareholder pressure, perhaps on the climate side, maybe they just need higher oil prices. And what would happen? I mean, normally, I mean, if you leave everything to the market to sort itself out, what's going to happen is there is a need for more supply. If that supply is not coming back and we just continue to consume more, so demand is higher, with that divergence, what's going to happen inevitably is just higher oil prices. And even though some of these majors, of course, there's that pressure by investors for them to kind of divert more capital into low carbon businesses and less into the legacy businesses. We have seen, I mean, I think BP is a good example of how they may just do a little bit of a U-turn, right? And then they may just say, actually, we are going to invest a little bit more into the legacy oil and gas business. Actually, we are going to maybe spend a little bit less on everything else. I mean, of course, these would probably come with some friction, but I think if oil prices go higher, if the returns in the fossil fuel businesses are above 20%, in some cases 25%, then that becomes very difficult to ignore for some of these majors. And what happens is that capital is being almost forced back into the space. So perhaps it's not going to happen as efficiently and as quickly if it weren't for these external factors. But I think at a higher price point, it will eventually happen.
Well, we're going to have to leave it there. The week goes on. Oil prices moving in an upward direction. Will they even get to 80 this week? They could. But addressing some of these points that Sarah brings up and Salah just closed on, we've got an interview just posted now with Robert McNally describing the current moment as the foothills of a multi-year boom oil price, given this sort of ultimate collision that no investment demand adds 10 million barrels over the next decade, and 1 and 1 is 2, and you get $100 plus. But that's our podcast for 4 years from now. The podcast for this week is, what will OPEC Plus do in 2 weeks' time? Will they go for deeper cuts or simply formalize this voluntary cuts? We'll have to wait and see. But either case, I think both possible outcomes will be lifting the oil price up to $80 as we march into Vienna. Virtual Vienna. Sarah Akbar, as always, awesome to have you back. Thank you so much. Salah Yilmaz and Rachel Ziemba, really appreciate your time this morning. We'll catch up with everybody 10:30 UAE time each morning. All the best. Thank you.